Well, good afternoon here in London, but I might say we're absolutely delighted to welcome a guest from North America today, Jeff Cohen. Hiya, Jeff.
Hi there, Michael.
And today's program is on the right balance, using a quantum annealing computer for your portfolio. Now, many of you will know that as the man in the white coat today, we're going to go and hopefully get a small peek at Jeff's lab. We began writing about the potential for quantum computing and finance back in 1997 and 1998 when we were involved in establishing the European Institute for Quantum Computation. Well, that's a long time ago, some 23 years, and things have moved forward quite significantly, not only significantly in 23 years, but even significantly in Jeff's case in the last 6 months. The progress that he and his team are making is interesting. We're going to be exploring that. Before we do so, I have to thank our sponsors. I don't think any of them would have expected us to be talking about quantum computing and finance as little as a year or two ago. But things have moved and they're real, and Jeff is delivering real applications and has real clients. And that's a long way from where we were when David Deutsch or even Richard Feynman were writing about what quantum computing might just possibly mean. So we thank our sponsors who are enormously tolerant and let us range across technology, economics, and finance. The agenda today, as ever, is my job is to get out of your way so you can get a handle on what Jeff's doing. We'll be coming back after about 20, 25 minutes with Jeff, and we've got a lot of good time for questions, comments, and answers. It's a challenging subject, I know, but Jeff has worked very, very hard to cut a challenge I gave to him. It was almost at two levels. One, explain it, but two, prove to the people who do know it that what he is doing is quite real. And so Jeff has cut and pasted in some of the real code and work that they're doing also, so that you can see that it's by no means fictional. So with no more ado, I'm going to hand over to Jeff, and I just have to switch over on the slide set here for a moment, and we're away. Jeff, the floor is yours.
All right. Well, thank you very much. And thank you, everyone, for listening. I appreciate it. I'm Jeffrey Cohen. I'm the president and founder of Chicago Quantum, which is an entity under U.S. Advanced Computing Infrastructure Incorporated. So we're going to talk today about the right balance using quantum annealing computers to help pick stocks. And so what did we do? We took 12 months of historical data and we're analyzing using something similar to the Sharpe ratio, but Sharpe ratio doesn't work on a quantum computer, so we had to come up with a new formulation. And so it picks efficient portfolios. We did it for 40 stocks because you can use brute force to validate. We then did 60 stocks, and actually on DWave's 2017 architecture that we use, the maximum is 64 stocks at a time. We use 5 different classical solvers. So some of you that are quants might understand genetic algorithms, simulated annealers, and Markov chain Monte Carlo analysis. We are now adding a simulated bifurcator to the model as well, which is really advanced and quite fast. So we've scaled to 1,855 stocks. Classically, 64 stocks with a quantum computer. We have published 2 portfolios, and we've kind of published the results. Today, they've not stood the test of time. They are more short-term, 1 month, maybe a month and a half type of predictive models. Next slide, please. So what is this new formulation? Well, if you look back at the Sharpe ratio over to the left, that is the weighted portfolio with the beta of each stock times the expectation of the return from the market. So then you would add back, of course, your risk-free rate of return. You divide it all by the standard deviation. It's a great model and it works. However, it's division, and quantum computers don't divide. They add and subtract. And so over to the right, you see the Chicago Quantum Net score takes the variance of that weighted portfolio and it subtracts the expectation of the return of that portfolio raised to a power. In this case, 2 plus alpha, where alpha originally equaled 1 and has varied as high as 2. Next slide, please. So to show you this formulation works, the way you read these charts, these are your traditional hyperbolic curve Sharpe ratios. The yellow dots come from Monte Carlo. And so I'll just point to one over to the bottom, second to the right, 1.63 million Monte Carlo hits versus 115 out of the quantum computer. The red dots are right along the hyperbolic curve. They are efficient portfolios, but a quantum computer can give us way more than 115 portfolios. It just did it so quickly. The blue dots are your classical solvers, your simulated annealer, your genetic algorithm, and your genetic algorithm fed with all the other analyses. And you see that those are ultimately your efficient portfolios. So whether it's 2 stock portfolios provided by the quantum computer or 3,500, you see that they cover the landscape of the efficient portfolio. That made us feel great. Next, please. So what did we accomplish? We stayed very focused on US liquid equities. And now that we've done 64 stocks, we understand some challenges. So there's a potential for, maybe 300 stocks on the Pegasus, on the new DWave system that came out in 2020. And we realized we need faster methods. So whether it's a simulated bifurcator or quantum walks on graphs, if we're going to analyze every stock in the United States, every common stock at one time, we need the fastest solvers we can get, and we are on our way with the simulated bifurcator. Next, please. So what did we do initially? So we ran the model for 60 stocks, quantum computer versus classical solvers. They all pretty much gave us the same answers. In this case, because the market had gone up a lot and stocks were very rich, it was a 2-stock solution out of 60. And so the lower left, you see that the genetic algorithm solved the problem, found the ideal portfolio in 7 seconds. The DWave simulated annealer, 11 seconds. Our own custom annealer, 15 seconds. The DWave took 21 seconds, but that included all the calibration time. We think if we were to repeat it the same way, it'd be 15 seconds. Monte Carlo took 24 to run 221,000. And the genetic algorithm fed by DWave, in this case, we think we had a memory leak. It was 48 seconds. We went back and reran it. It was 6 seconds. So what we've shown is we can run classically 5-10 seconds versus DWave, which if you ran it one time, it's less than a second. If you run it a whole bunch of times, it's maybe 15 seconds. And then we had some other samplers that did not work well, so we won't talk about them. Next slide, please. So initial results as well. So 2 stocks. In this case, it was Ameriprise and Apache. So a mid-tier financial service company and an oil exploration company in the United States. And actually, we're going to talk about it later, but for a period of about 25 trading days, this portfolio outperformed the market. After 48 trading days, it is either in line or below the market because of the unique loss of diversification of just having 2 stocks. We also realized that a high beta stock is much more likely to be selected because there's that chance of extra profit. So you take high beta stocks and you have them have basically an inverse or negative correlation. So the covariances kind of counter each other out. So I have a very low variance expected moving forward, but a very high beta. So if the market goes up, the stocks go up, but they move counter to each other. They zig when the other one zags. Now the models are giving us 4 or 5 stocks at a time, but it's good to know. Next slide, please. So initially, our results were very optimistic. So if you see in the upper right, we published a couple portfolios, a Chicago Quantum Net Score, which is the one you saw, which is expected return to a power subtracted from variance. We also have a Chicago Quantum Ratio, which is the Sharpe Ratio, but without all the nominal terms. We could just use market momentum on top, which is the covariance of the stock to the market, in this case, the S&P 500, divided by the same standard deviation. And the Chicago Quantum Ratio actually tracks the market really nicely. It's almost 7% to 7%. But our ideal portfolio, which was Chicago Quantum Net Score, achieved a 13.93% return versus the benchmark of the 60 stocks of 7. So terrific first results. We published them. If you go to the next slide, please. So after a while, though, the returns actually fell below the market. So the market has fallen since that first checkpoint, and the S&P 500 is still up around 7%. All stocks are up 4.4, those two ideal stocks are down about 1%. The Chicago Quantum Ratio, which again, similar to the Sharpe Ratio, which we also run, actually outperformed everybody. And so just coming up with a kind of a taking away all the factors, the nominal factors, it shows the efficient portfolio very nicely. So, but you see 25 trading days compared to 253 trading days of data. It held its predictive power. After 48 trading days or 20%, we can't expect it to keep going this way. So next slide, please. So another portfolio we published had 4 stocks in it, and this was published on Friday, August 28, before a recent downturn. And as the market declined, the Chicago Quantum Net Score actually declined slightly more than the rest of the market. And again, we believe because it's taking those high beta stocks, and even though there's less variability, you can't fight the tape on this one. So, but we're excited to see how this does as the market picks up again, just not today. Thank you, Michael. Continue. So let's get into some details. Next slide. So these come from the actual software. So we offer this software as a service to clients. You can hire us $150 for a quantum portfolio, $50 classical, or the way we would expect to work is we sit with your teams and we explain how we do it. We teach you how to do it. But what happens is, as you place your linear and quadratic terms into a matrix, and that matrix, also called a cubo, is fed into the quantum computer, the larger and larger the number of stocks, the smaller the terms in the matrix. And you'll see here that the linear terms, which have your profit or expected return, are going to be in the range of negative 0.2 to negative 0.9. But the quadratic terms that are off the linear, off of the diagonal, are small, 0.004, 0.003. So that's why it's yellow. So what happens is the larger and larger the portfolio, the tougher it is to get that rich energy landscape that the quantum computer can grab onto. At this point, we're still finding solutions up to about 45 stocks, where the quantum computer can settle in on a settled energy landscape point, a minimum point. Next slide. Another scale challenge is if we just run out of qubits. And so the DWave has 2,048 qubits. Right now, 2,030 are operating for the system that we use. And this chart shows the 60 stocks as they're laid out, and the yellow lines show one stock. So what happens is, for one stock to talk to every other stock, for the variance covariance terms to be connected, you need to repeat that stock over and over again. It's not just 64 qubits for 64 stocks. In fact, it's 1,300 to 1,700 qubits for 60 stocks. And we found out theoretically the most stocks or fully connected vertices or clicks you can have on this Chimera architecture is 65. So we run 64 just to make sure it's going to work great. Next slide. Another scale challenge is when you're setting your 64 click embedding, this is what it looks like over to the right. Every stock, every point, there's a list of every other qubit that would have that data. And so we could manually create an embedding and then use that over and over again. So let's say we had a favorite set of 64 stocks. We could set that up and run and actually get a better predictive power. It's costly in manual labor, but you can do that. On the Pegasus, we're expecting they can embed significantly more than 64 stocks. So that's going to be terrific for us. Next slide.
Jeff, just a quick question. Could you just explain the difference between the Pegasus and the DWave? Because not everybody's deep into this.
Oh, absolutely. So the DWave, what they call the 2000Q for the 2000 qubits, was released in 2017. It offers 8 qubits in a cell, and then 16 rows and 16 columns of those cells, and each cell talks to 4 other cells. And so if you want stocks to talk to the other stocks, it's 16 by 16 by 4. And so the good news is there's a new release. It's called Pegasus. It came out in 2020. It's been shipped to one client already. So we do not have availability yet on the cloud service, but that offers over 5,500 qubits. And it also, I believe, offers 16 connections between groups of qubits. It looks a lot more like an Intel Pentium processor than the way it used to look, which was more like a research project. So with that greater connectivity, we're expecting about 8 times more capacity on that new hardware. So 3 years, 8 times more capacity. We can't wait to get our hands on it.
Thank you.
So this next one's interesting because it shows, so quantum computers are probabilistic. And that energy landscape, it matters. It's like climbing a mountain. So the orange dots here are the mountain. The orange dots are the number of stocks that you want to pick each time. So when we run our portfolios, we have to tell the DWave, pick the best 2 stocks out of 64, the best 3 stocks, the best 4 stocks, the best 5 stocks. So those are the dots. You see, for one client, this is an actual client run, we ran from 2 stocks to 40. The blue is the actual values. You want those values to be right with the orange. So you look up and down. So the first one didn't do very well. The second one, we changed some settings, it did worse. The third one, it did even worse because the blue was so far away from the orange that there was no real matching. The fourth one, when we worked the settings, you see the blue is surrounding the orange. So what that means is we got tons of great values out of the DWave. That's what we call calibration. So now that we've calibrated it, we can run it over and over again and pick up hundreds of portfolios that the DWave might recommend and then pick the best ones. We also ran it backwards. And it was basically an experiment for this client. If we ran this simulated annealer backwards, what happened? And wasn't quite as good, but some of the portfolio values actually were quite nice. And so the idea that we can do this on a simulated annealer, which is the picture here, and then also visualize it on the actual quantum computer means we save time and money for our clients. And so this was an engineering accomplishment. Next slide. I'm going to go even faster. So you do a Monte Carlo analysis. This is the Chicago Quantum Net Score. By the way, a lower score is better. And what you see here is that the fewer assets, the better the possibility of a great score, but also the possibility of a terrible score. So you have to be really careful when you pick the small assets. In the middle, you can see there are around 20 to 40 stocks in a portfolio out of 64, and over 2, you have tons of values, but they're all pretty much in the middle. So there's not a lot of room for improvement between 20 and 40 stocks. But if you can pick between, let's say, 2 and 10 stocks, you can get some real winning portfolios. Next slide. So the accomplishment was just the visualization. Another visualization here. On the left, you see the Sharpe ratio. So you can see the first million basically runs show you that the Sharpe ratio is in a tight band. And that the best Sharpe ratios, they aren't very different than each other. There's lots of efficient portfolios that you can choose from. This is why there's so many investment managers. And then you see in the Monte Carlo what we call the fat tail, which takes 2 portfolios, 3, 4, equally distributed across. You see that the Sharpe ratio, there's a little bulge up in the smaller portfolios, but a terrible, terrible set of portfolios that are small. So you really have to be careful picking small portfolios, but it's hard to find a great one. You see with the slide to the right, this is the Chicago Quantum Net Score. You see that the same Monte Carlo run, again, gives you that band. And then to get really great or poor Chicago Quantum Net scores or highly efficient, not efficient scores from the portfolios, you're really in that smaller portfolio range. We run this classically first for our clients to get a feel for where that best point is. This was actually run late last week for a client. Then you can start to focus in on, okay, how are we going to find those great portfolios? And does the client have interest in a 3-stock portfolio? Do they want to make a quick bet? Or are they looking for maybe 8 or 10 stocks to hold for 6 months to a year? Next slide.
Jeff, we just had a question come in, which I'll take because it's really related to what you've just gone through. It's from Yin Kong. On what basis were the 64 or 40 stocks selected, and what was the number of stocks in the universe from which these were selected?
Great question. So although we can run 1,855 stocks at one time, which is 10 to the 551 power, we don't. In order to have the DWave match classical, we just picked, in this case, it was 60 stocks. For these charts, it was 64. And we prefer our clients to pick those stocks. our value, our measurement is no accounting irregularities, positive beta, and they have to have continuously traded for 253 days. As long as they have that, they can fit into our model. And so it was 64. In the case of the paper, it was an alphabetized list. In the case of our clients, these were dividend aristocrat stocks.
Thank you.
Yep. Next slide, please. So if you ever want to read the papers, and you'll have the slides, you can take a look. We are on Archive. We're on Medium. We like to publish the open things on Medium, such as a stock portfolio pick or what happened when you try to load 72 stocks on a DWave. Did it catch on fire? And we're also on ResearchGate and Google Scholar and things like that. So next slide, please, because I want to dig into, I want to keep going into the app. So next slide. I'm going to cut over a couple slides here. Next slide, please. Well, I'm going to even avoid the public service announcement here. So we have a great team.
Oh, wow.
Next slide. All right, the system we built. So I'm going to slow down a little bit and talk to you about what it is we do every day. So we offer a Chicago Quantum Net Score, classically, which we run on a personal computer, and we'll analyze up to 64 stocks for $50. By the way, if you twisted my arm and said, Jeff, I want you to run 1,000 stocks, we can do that. It takes longer, it takes about an hour, so the cost will go up. If you want to run 64 stocks also on a quantum computer and have that validation, we do that for $150. So you go to the website, you pay, you send us your tickers. We do a little email back and forth because we validate all the stocks, and then we run it for you. We write like a 10-page report. So that's how it works. And we tune the system for that portfolio. So one of our clients, I think a very sophisticated investor, their stocks didn't coalesce into a solution until we ran it a bunch of times. And so even the quantum annealer didn't really grab on. It was a rather sophisticated portfolio. Now the dividend aristocrats portfolio solved it right away. Oh yeah, pick these 4 stocks, wrap it up. So different portfolios of stocks, it just takes more time or deeper analysis to find it. So that's how we run it. By the way, we're adding the simulated bifurcator. So what that will do is when we grow to 3,200 stocks at once, which would be all NASDAQ Q and all New York Stock Exchange common stocks, we'll be able to run them in a few seconds, but at least a few minutes. And that'll be terrific. The simulated bifurcator was only really invented, I think, in 1989. And that one research paper that we found had 3 flaws in it. So we redid the paper, we corrected the flaws, and now it runs for us. So that's terrific. Next slide, please. So again, we download the data. So if you wanted a lot of tickers, we download it from NASDAQ, or we download from Yahoo Finance your tickers. We understand the market over the past year. We calculate all 64 stocks. So we give you the Sharpe ratio, the expected return, the standard deviation, the Chicago Quantum Net Score, Chicago Quantum Ratio. We run all of those baseline metrics just to get a feel for the absolute average. Then we run Monte Carlo. We run it around N/2, so right around that discrete probability of 32 stocks. It does okay. We run like 1 million. We can run, at one point we were running 100 million just to really get that good feel. And then we run each portfolio slice. So 2 of 64, 3 of 64, 4 of 64. And then we catch on to the best portfolios and we hold them for later. Then we run our genetic algorithm. Best scores, hold them for later. Simulated annealer, same thing. Taboo sampler, and really any other solvers that we might have included. We're adding the simulated bifurcator. It doesn't run yet today, for full disclosure, in our model. We run DWave, and we have 3 different ways to embed on DWave, and we find that different embedding, if we play with the embedding, we get slightly better answers. And then we do all the tuning, and then we run it back through the genetic algorithm. We call this saga. So annealing into genetic algorithm, it gives you a deeper minimum. We almost always can find the best answer much, much faster for a client. And then we show the results with a voting method. So the good news is when 5 or 6 methods all pick the same couple of stocks, But in other cases where they don't, we show a client the voting that was done by each method. Next slide, please. So upper left, we're going to go left, top to bottom, right, top to bottom. There's going to be 7 of these to show you. The first is, so we should have either 252 or 253 days of stocks. So in this case, we had 253. We downloaded 64 stocks for the client, 4 indices. We then calculated the market return on this day. The market return minus the risk-free rate was 10.95%. We set a floor and a ceiling to everything. The all-asset portfolio had a Sharpe ratio of 5.44, had a Chicago Quantum net score, and it would return last year, it returned 11.53% and a 2.12% standard deviation. Upper right, the discrete probability gave us a Chicago Quantum net score at pick 20 stocks, negative, just call it -3, -3.5. The one where we did the fat tail, 3 stocks, -7.7. Then we did the genetic algorithm, gave us the same 3 stock answer. Then we did the genetic algorithm after the fact with the DWave seed and all the other seeds, and that was 3 stocks, 7.7. So we knew we had a winner that was consistently being chosen by the different methods. Next slide, please. And then we show the stocks. So in this case, there were 64 stocks. You can see them on the bottom. And I'm just going to walk you through. So the Monte Carlo random picked ExxonMobil, Leg Mason, T. Rowe Price. So it's funny how oil and kind of mid-tier financial services firms tend to not operate together. They tend to zig while the other zags. I mean, kind of makes sense, right? It's like guns and butter, right? They're kind of opposites. And so the genetic algorithm random. So the first one ran in 109 seconds. The second ran in 47 seconds, then 40 seconds, then 111, 85, and 83. And that's because when we run a client's portfolio, we're not tuning for speed, we're tuning for depth of solution. So what's interesting is the QA, Quantum Annealer All, it actually added O and SYY to the portfolio. It didn't want to settle on those 3 stocks, so it picked 5. It was consistent with the other 3, and it added 2 more. So the client was fascinated. He's like, well, what made those 2 stocks such that the DWave energy level, that it really grabbed onto that energy level? And so for them, that's a conversation they can have with their client. What made it different? Next slide, please. And so our software runs on Python 3.7. It runs on a PC. The back end is a DWave System 2000Q. In this case, over to the right, you can see the actual screen print of the actual jobs we ran. And at this point, it was running at 13.5 millikelvins, which is much colder, maybe 1,000 times colder than deep space. And there were 2,030 qubits operating. And again, we FTP and validate the tickers. We've gone through all this before. The maybe other interest is we're accessing the DWave. We don't have one in our data center. We access it through the Canadian cloud. They have a cloud system that they offer. And I think that's it. One more slide, and then we'll open it up for questions. We're right on time. So these are some charts. I just wanted to walk you through some of the visualizations we get out of the system. The top middle for this particular client, this is all for one client. The yellow is 1.63 million Monte Carlo runs. The blue is the genetic algorithm, the simulated annealer, and the Monte Carlo. And the red is what the quantum computer gave us. And so it picked right along that hyperbolic kind of efficient frontier curve. Now, it's hard to expect 115 picks from a quantum computer to catch every inch of that efficient frontier when it was set with 1.63 million. But the fact that it got that close is amazing, because if it was random, it would be all over the slide. Lower left, you've seen that before. That's the Chicago Quantum net score versus the first million, and then the last 630,000 Monte Carlo runs, which were by portfolio size. Then you see the same thing with the concentration in the center. Then you see the runs out of the simulated annealer. This is number of stocks chosen versus what we wanted it to choose. This next one shows that when we came up with the last two, the Chicago Quantum Net Score took on that shape that we expected it to see. So this is where it gets a little tricky. If you just throw something on the DWave, and we know people who do this, right? We did it when we started. You get these curves that don't make any sense. There's no validity to the data. The first three didn't work. And I remember when we first got the DWave access and we'd compare it to our classical formulations, because remember, 40 stocks, we could validate everything brute force. The numbers didn't make any sense. We spent months making sure that the DWave did exactly what we wanted it to do. And there you can see it, kind of like a scatter plot 4 and 5 are the types of shapes that we would expect to see coming out of the Annealer. And then the fifth one is the Chicago Quantum Net Score versus the number of stocks. And you can see that wide spread. 2 stocks, huge spread. Terrible, terrible portfolios with only 2 or 3 stocks, but some great ones too. And then as you move further, the range tightens because diversification kicks in. All right, Michael, I'm going to hand the slides back to you and open it up for questions. Thank you.
Well, thank you so much, Jeff, and you kept to time. It's been a lot, I think, for the audience to absorb, and so there are going to be a couple of questions. We might just wind it back a teensy bit, if you don't mind. Matthew Leach is just trying to understand the problem better in the sense of what is the advantage of the quantum computer? Does the quantum annealing approach give better solutions, the same solutions but faster, both, neither, or is it just the comparative aspects against the other methods?
So our point of view on the comparative analysis and what makes it better has changed over time. So it doesn't scale as much. So it only scales to 64 stocks. And of course, classically, we can do thousands. It doesn't give you a better answer. It gives you a slightly different answer, but not a better answer, because we've got great heuristic algorithms. It is faster. So if you could tune it just right, you can get your best portfolio out of a DWave in under a second. But let's be honest, the setup time, the programming time, the cloud time, you're still talking 4 or 5 seconds versus a genetic algorithm, which could be 5 to 10 seconds, maybe 15 to run it, all in. So the advantage right now is that you have a comparison of quantum versus classical methods. And when we do have access to that larger system, we'll be able to scale it even more.
Right. So to me, I guess one of the big examples there was where your quantum annealer was saying, no, I really need 5 here. And that allows you to get that kind of comparison. Very good. I mean, in real life, are clients really trying to boil down their portfolios to these really tight numbers, or are these just things that they're looking at in terms of comparison as well? More thought experiment.
So in the spirit of not reaching over the camera, I was previously an investor in Vanguard's low volatility fund, minimum volatility fund. And I want to say that the cost of that fund was like 20 times more than the cost of a similar passive fund. So people like me, before we had access to all these tools, they are paying for it.
Mm-hmm.
Personally, I hold hedge funds. My cost is 7%. It's killing me per year. But I do that in order to get the diversification and reduce my volatility of my overall portfolios.
Mm-hmm.
I'm not going to suggest that people would pay us 7%, but they might pay us $150. So there is interest in the market for lowering volatility of a portfolio.
Mm-hmm.
The holy grail. Now the question is, would you do it as an investment manager for 64 stocks? The answer we've gotten from what I'll say big name investment managers is I'd much rather you do it for fixed income.
Oh.
Right? Equities is easier. We're all doing equities. We've all got Monte Carlo, but fixed income's tricky. And the reason is that the trading frequency and the frequency of the data updates is different. And everything has to be in the same frequency for this to really work, because your covariance terms won't work. So the reason we don't do mutual funds, by the way, Financial Engines does a great job on mutual funds. The reason we don't is you've only got the NAV once a day, versus we could go down to minute by minute, variance covariance terms.
Yeah, got it. Yeah, so the data. Is there a point where, well, let me try this. There's a bit of a hardware race going on here, and
Yes.
you're looking forward to your Pegasus. I could
Oh
see
yeah.
you. You're like a boy who's looking at the new bicycle in the window there. Um, so, as you're looking forward to, do you foresee a point when, in fact, the classical heuristic methods aren't necessary, or will they always be there for comparison? And if you are going to kind of throw them out, any idea of timeline on that?
So spirit of full open disclosure, right? So at first we thought the quantum computer would be faster and better at all these classical heuristic models.
Hmm.
And then I hired in a senior associate who's a PhD in math who does discrete math models for a living. And he quickly convinced me, Jeff, we're not going to show quantum advantage yet.
Hmm.
But the good news is we're going to make a good horse race. And so what I would say is we're going to max out our PC probably at 5,000 stocks. And we might max out a pretty big server at 10,000 stocks. But as the quantum hardware gets better and better, and they can go from 64 stocks to, let's say, 500 stocks to 1,000 stocks to 10,000 stocks, at some point there's a crossover where the quantum will be more powerful, or we'll come up with a better algorithm to run on the quantum computer that gets us there faster. And so I don't see it today in DWave with the 2020 server, but if you look at IBM and others on the gate-based computers, I mean, they're talking about exponential scaling each year. And so it only takes a couple more kind of versions of these pieces of hardware for it maybe to be better. And a client that would work with us today, they know how to take advantage of that next version of the hardware. They're all set. So once it's there, they might pick up 3 months of advantage over their competitors.
Interesting. I mean, speaking of these other architectures out there, and well, I guess two questions. I mean, one, how wedded is your approach to D-Wave, or is it that's what's around now and I could move easily? Uh,
So we originally wanted to run on the IBM Q.
mhm.
One of the reasons is I used to work for IBM as an executive. So I thought, this is going to be great. It's like coming home. The problem is with 5
Wrong color
qubits,
tie.
it's okay. This tie represents my love for the color. So, so, but it didn't work. It was only 5 stocks. What can I do with 5 stocks, right?
Yeah,
I can do that with pencil and paper.
yeah,
And then,
okay.
Honeywell's got 6 qubits, so I could do 6 stocks. It's just not enough. At least with D-Wave, we could do 64 stocks.
Hmm.
At some point, those guys are going to catch up. Now, truth be told, these systems, you take a cubo, which is just a matrix, a square symmetrical matrix, and you load it. There is another architecture, Fujitsu's digital annealer, that could promise thousands of stocks at one time with the type of speed that you would expect from a quantum annealing computer. It's not quantum, but it's like one of those big SAP environments, highly connected, lots of RAM, but it just runs qubos. And so we're hoping that we could run this on the Fujitsu digital annealer and then say to a client, this is where a quantum computer might be 3 years from now. At least you can get that advantage today.
Okay. And just on this, Clark Alexander is trying to help here. He says that the simulated bifurcator is from 2019. Is that what you meant to say, or are we in a kind of a terminology area?
No, I thought the paper was from before. It's really from 2019. I thought it was a joke.
Yeah. Okay. Well, we'll leave folks to rummage around and clear up that one. But thank you, Clark, for feeding that in. Bob McDowell's curious: how does the quantity of stock relative to the stock in issuance reflect in the quantum analysis, or is that not a factor?
So if you're looking, let's say, at 20 stocks, then you're looking at 2 to the 20 possible portfolios that you have to look at. If you're looking at 64 stocks, it's 2 to the 64, or that's roughly 10 to the 19th. That's a big analysis, and so you need these heuristic methods to quickly get to the right answer. If you're looking at 1,855 stocks at once, that's 10 to the 551 at one time. You can't possibly even think to search that environment. It's like the size of the universe. And so you have to come up with heuristic methods to quickly get you to a good enough solution. And so
Yeah,
size just adds complexity.
it does indeed, doesn't it? Um, and I'm just one of the things I'm kind of interested in is there are other portfolio issues out there beyond finance. So I'm thinking of, for example, logistics or R&D optimization frontiers. Have you had any experience of using this type of approach there?
So one of our team members is giving a presentation on COVID and his use and his team's use of DWave to track the spread of COVID. And just to give you more of a tongue-in-cheek kind of response, if I live in a town, what restaurants would I close or what bars would I close
Mhm.
to maximally reduce the spread of COVID? This is a great use of a quantum computer. And there's so
Wow.
many others. There's bus routing. There's
Mhm.
leaving the scene of a natural disaster. What roads do you take?
Mhm.
Any of those types of optimization problems are great here. Not stock picking, but like asset picking for a retailer to pick orders, sealing the joints of a vehicle. What's the order in which I seal the joints of a vehicle that I can save money and get my robots to process more vehicles?
Mhm.
Um, if I'm running advertisements on the internet, click-through rate, how can I make sure I don't spend all my advertising budget in the first hour of a campaign? Those are all today's use cases for the same quantum computer.
It's a fantastic field out there. It's been a long time coming, but I think it's great that you've shared with us, and it was very kind of you to put some of that detail in there. I know it often frightens off an audience, but I think in this case today it was good to just see this is real stuff. This isn't somebody in a laboratory saying, "Oh gosh, it's going to happen sometime in the future," but I've worked out an algorithm for it because you're using algorithms today, and I think that's
Correct.
super. Where do you see the future of the market coming? Kind of my final question. Or is this going to become a common technique and you've got just a 3 month lead on some of the competition? Do you expect all investment banks to be using this in their dark pools or where's this going to go?
So from the perspective of portfolio optimization, I am always surprised. Last week on Thursday, I heard about a Portuguese startup who's using similar methods than we are. So what I would say is the models that we're using are commonly used across the startup community. It's because it's the only thing that seems to work. And so it's always a question of first to market, first to the clients, get those relationships. What I do see is the broadening into other asset types is going to be what differentiates the market. And we're going to drive customers to those quantum hardware providers. Because if you could make money in the stock market, you could afford the couple of $1,000s for the usage, or even a couple $1 million for the computer, if you could consistently outperform the market for your investors. And so, but again, the market's going to respond as well. And so, um, I think it's just building the skill sets. I think the investment houses are going to either hire the skill in house. Let's be honest, they could spend $500,000 for a great managing director, or they can spend maybe $50,000 working with a firm like ours.
Hmm. Well, and is your next asset class going to be fixed income? Is that given what you've been hearing back?
It will be fixed income partnering with a financial institution.
Hmm. Well, folks, sadly, we've come to the end of time, and I've got to, well, actually, we'll just Jeff, you can answer this quickly, and I'll send a link so you can connect. But Incon had another answer about how do you handle short positions on stocks, ex-US stocks, and minimum maximum limits on relative position sizes and things like that. Is that something you want to pick
I'll
up
give you a quick.
offline?
I just
Okay,
give a
go
quick
ahead.
answer.
Sure.
So to simplify the problem, we assume equal weighting. No shorts, So if you had 100 stocks, it's 1% of your money each. If it's 10 stocks, it's 10% each. We believe that a market capitalization weighting is better, but computationally, it would add some complexity.
Okay, good. Folks, as I said, we've come to the end of time. I will be sending all the questions over to Jeff, and if he wants to answer or get in touch with you, he can. But sadly, and I can see a number of people thanking you very much, Jeff, for that,
You're very
wanting your
welcome.
slides. The slides will be posted. May I make 3 quick rounds of thanks? First, as ever, to the sponsors. I think it's super. Many of you will be using these techniques, or they're certainly on the edge of what you're about to start doing. Anybody who's in technology, economics, or finance has certainly been keeping an eye on this space. And it's nice to see a pioneer here today. Second thing is to thank you, the audience. Thanks for your questions. It's one of our more technical subjects, but one that is quite dear to our hearts given how long we've been at it. Later this week, we have Steve Waygood, fascinating gentleman who's been deeply involved at Aviva in promoting the climate change agenda, one of the real leaders in the field. On Friday morning, we're launching the Global Financial Centers Index number 28. I don't know why it says 27 there. Also, we've got a session on our employee share ownership, a focus on San Francisco, and a really interesting look from deep inside Brussels on the magic money trees of Europe. So it's going to be a great week ahead and next week as well. And we look forward to seeing you there. But if I might, Jeff, in these days of COVID, portfolio or non-portfolio, it's very difficult to let the audience kind of get in there and thank you. So I have to do it myself. And I have here my, from my Buddhist temple in Korea, my karmic clapper, which will thank you. So thank you very much, and really kind of you to come. And we look forward. It looks like we may have to have you on quite often because the speed at which you're moving is impressive. Thank you so much.
You're very welcome. Bye-bye now.